All right, just double check. You can see my screen at the clubhouse here. Somebody give me an okay or
Yeah,
a
yeah, you're good.
beautiful. Thanks, Jack. Okay. So, here's what we're going to cover. I'm going to give you the Three Report Weekly readout. I'm going to show you what you folks are getting that few others are. We do have a new service on the old platform we came to Seeking Alpha from. That's Substack, and so we do have kind of a limited sort of quick scan research version, but the threes report and the roar score is included in it. And so I'll walk through the whole thing. I literally just finished it a few minutes ago, and we sent it out. You folks get it, first, of course, to get everything first. That includes some research I'm going to talk about, which I think you'll be interested in. And it also, I think uh, the other interesting thing that is going on is that while the markets are kind of stagnant here, there's a lot going on underneath. And I'm going to show you again, I think, what the difference is between having the threes report and what Dana, my wife and business partner now, affectionately refers to as the ones report, because it's just a fraction of the threes report. Um, and as a matter of fact, the first question that I see in there talks about things that are overextended. So you're playing right into my wheelhouse with that. So thank you. We'll get to that. Um, so I'm going to go through the read up, but I'm also going to go through some of these tabs. I try to update them all before we talk on Tuesdays, and I have gotten to most of them, but I've at least scanned all of them, and so I will look at that. Look, not a whole lot going on at the surface level. Really is not. So let's get into the threes report. Uh, and I've got a little something here too I'm going to share with you as well. All right. So, and look, I mean, the last headline I saw was the government was going to shut down at midnight tonight. They couldn't come to a conclusion. I know, healthcare differences, what else is new. Uh, and I talk about that in here. You'll be able to read it, but I'll highlight a few things here. So first, stagnant markets, okay, but sector level or really industry level clarity is starting to emerge. And that is really where I'm kind of headed with my research. Sure, I'll give you a portfolio crafted with my own money, and where every time I make the trades, you get a trade alert. But I think what's really important in trying to achieve our mission at Sun Garden, which is educating do-it-yourself investors and teaching them to fish as opposed to just giving them fish, as we like to say. I think the important part of that is for you to see every week and even in the interim what I see in the charts, because that's my focus, has been for decades, and it's really coming in handy right now. Uh, Frankly, if we can simply help you over time to not make big misjudgments when making investment decisions, whether it's what you own, how much you own, how you own it, even why you own it, or in what form, then I think we've really added a lot of value. You almost can't put a price on that. At least I don't think you can. Decision making and getting your chops, as they say, raising your game in terms of decision making, because otherwise it's like that old was it John Mellencamp song? Uh, if you fall for something, you'll fall for anything. It's been too long, but no, you got to stand for something. You got to stand for something, or you're going to fall for anything. So that's to me, you have to stand for something. You have to have an investment process philosophy. Borrow as much of mine as you like and personalize it to yourself. That's really what Sun Garden Investors Club is all about. So now let's take a look a little bit under the surface here, and I'll show you some charts on these. Okay, defense stocks. Look, I know there was a big thing at Quantico today, and my lord, it was a long speech, but I'll leave that to you guys to debate. I'm not going to talk politics here, but I don't know. Maybe that was a sign of something, because defense stocks look, increasingly attractive. European stocks are looking a little bit better, nat gas too, and a few others I mentioned here. Some of the retailers, the big ones and the not so big ones, might be signaling a economic slowdown, if not an outright recession. As I say, toward the end this week, I think recession has already hit a lot of the population, just probably not the people that are likely to own a lot of stocks, things like that. It's the lower 2/3, let's say. So, look, here's a picture of Boots. Okay, I'd love to give the Roar Score, a nice swift kick in the pants. It's been at 20 for a long time, but unfortunately, fortunately, this is risk management. Okay, and that is again why we are so focused on having two levels of this. This is a conservative item here. Quick aside on the Roar Score. I briefly mentioned last week that I have somebody that's actually based in Europe, and we kind of work together tangentially through a platform that that a couple of my portfolios are listed on by the name of Surmount. He's effectively the de facto CIO there, not investment information officer, tech guy, and he's well on the way to automating the Roar Score about as well as I could do it, and Lord knows I've tried. So that could be very exciting. I think next week I might have a little bit more for you. Those of you who don't know, I'm speaking at the Money Show in Orlando in about 2.5 weeks. So I'm hoping to have it by then. Really, I'm hoping to have it by the Tuesday before then, because I want to show it to you very, very first. But we'll see. We'll see. Been at this for a long time. The good news is it's working on the eyeballing of the charts just fine. Okay. In fact, I will probably pen an article fairly soon. Not sure for which place, Bar Chart or Seeking Alpha, but I was looking at the Roar Score, and matter of fact, I'll just pop over here for a second. Okay. Here's what I notice about the Roar Score in your shared deck. Sure, it's been at 20 for a while. It was at 30 for a week, and then it was at 40 for a long time too. What's that, 11 weeks? Okay. And it was at 30 for a couple more. Okay. I didn't intend for 30 to be like the resting zone. Okay. But it has been. I mean, it really has not moved a whole lot this year. And there's two ways to look at that. One is, all right, well, the market's flying this year. Yeah, the S&P is flying, but if you're a conservative investor, I mean, personally speaking, because I am one, there's not a moment this year I thought, gee, I should have anywhere near 50% in equities when T-bills are still paying this much, and they still are. And that's exactly why we have the moderate version of the score, which has also been stuck but at 60, because remember, the moderate version, you take 50% and automatically put it in SPY, and you allocate the other 50% in this way, so that, that would be 50 plus 20% of the other 50 is 60. So it's still been 60%. And I am increasingly, I didn't write this in here, but I'm increasingly of the belief that if this market's going to fall hard before the end of the year, it's much more likely to be without any warning. The charts are breaking down a little bit in some areas, as I'll show you, but not in a huge way. At the same time, yeah, there's like three markets. Okay, it's probably another article idea. Jack, you can steal that one if you want. There's the very thin layer at the top, and I'll give you an example of that in a moment with some of the charts. There's some stuff that's already starting to break down, and then there's a whole lot of nothing in between. The stagnant part. So anyway, that's a little bit of a talk about that. I wanted you to know, first of all, okay, this, which is actually, they do a great job. Seeking Alpha's thing has they have an AI thing that reads what we just wrote. We can't use any AI, which is good for you guys to know. Pretty pure platform in that sense. But the AI puts this here, okay. But the rest of it is what I actually wrote. And just so you know, that starting today, people, we have over 2,000 people at least that have been getting the threes report for a long time, a few years. And we decided we've got to put the Roar score behind a paywall, and we also have to put most of the threes report behind a paywall. So the only people that are going to see the threes report that you have here are folks in this group and the folks in the Substack for $15 a month, $150 a year. But of course, they're not invited here, and their names and names and emails, and hopefully some of them will join this group. Not for everybody, but that's the very, very, very light version of Sun Garden these days. Okay, so what I wanted you to know is, okay, this is all they're going to see now. All right, and you can see the way I wrote it. Okay, and look, the indexes don't tell us that much. Like I said, they're stagnant. Okay, there's some clarity finally appearing. You folks are getting detail on the clarity. The people who just have been reading a couple thousand people for 3 years, 4 years, whatever, every week, and reading it in high numbers, they're paying for it now. So that's a business decision we're very, very, very happy with. There are some increasingly dangerous subsegments. Okay, this is going to be more of a tease every week for reasons that should be apparent right now. And again, some weak charts looking at the top 20 stocks, weak charts that back up the stuff I saw in the ETF, but also some good-looking charts that kind of surprised me, and I'll go through that. And then I'm going to try to keep this light whenever I can, talking about shutdowns as well as some NFL stars who have also been shut down. And you can read about that in your copy. I kind of stuck that at the end there. All right, so and I put the Roar score at the bottom just for these reasons. Okay, so this is a good reminder. Now we're into the paid part. Okay, a lot of what I do, I mean, if you saw how many things I look at and say, that's a good chart, oh, I could buy that, whatever. And a lot of times I do. That's what that kind of new trading scan is about. But literally, I could buy 100 different things and only later realize that a lot of them move together. Okay, that's a very intricate process in a market that more and more it says you're in the defense industry, you're a retail stock, you're all going to move together no matter what's happening at the individual company level. I see it more and more every day. And wait till you get to mid, small, and micro cap stocks, like some of the ones that I look at. I mean, they also, I mean, if you own a small gold company, gold mining company, gonna move with gold and it's gonna move with GDX and all that. So, uh, anyway, so it's never really a what to buy right now, but I do get plenty of ideas. It's what should I be paying close attention to, because I do not know how everybody manages their own money. And like I say, the charts fly a lot less than people do. So uh, I have kind of a good list and a bad list here. So let's get into them. And I'll just summarize this for you, because you've all just received it. So look, Europe has been moving very steadily. That's Fez here, Europe top 50. I like tracking Fez and AIA because they are both, they're not like the Dow per se, but they're and they're not necessarily all the biggest cap companies in Europe and Asia respectively. Fez for Europe, AIA for Asia, but they are 50 very large caps. So it gives me a sense of what's happening throughout those continents. Uh, China looks similar, frankly. It was a little bit ahead of Europe. Now China is still going, still going. Europe's joining it in this little extension here. This is strength. Okay, doesn't mean it can't break down, but that's pretty good strength. And you can't really see it here, but the S&P 500, is probably like up here. I think that gap's going to narrow, but it's not going to happen overnight. It's going to take a while. So, defense stocks. Again, I mean, I don't know a whole lot about the defense infrastructure. Uh, that is, I'm not an industry or sector analyst, but that's a chart that says, I was hanging out here for a while, not sure what I'm going to do. No worries, no harm done. And now it's got a bid. And yes, this is a daily chart, but that's a pretty good bid in a pretty good place for this PPO. And that is a different look, really, than I can see anywhere else in the chart. And let's face it, I mean, there's only a handful of stocks, maybe 5 to 7, that make up a lot of this anyway. You probably guess who they are, if not easy to look up. So that's ITA. The other one I mentioned here, and this was all the rage. I think on Seeking Alpha and a few other places, but SHLD is European defense stocks. And everybody was freaking out earlier this year about how, looks like Europe's going to have to arm themselves and US isn't going to help, etc. I got it on the radar. It's kind of back on my radar. And look, this is not what I call a great chart. It's what I call a good chart. And again, if you go back to there, okay, these are what I would call, it may be in an uptrend, but it's getting a little bit stretched. Okay, so this is not like golden. It's not sweet spot. It's not. It's just started an uptrend, and there doesn't look to be anything. Okay, to hold it back. When something's gone up this much, and again, I mentioned this in the Roar score too. Here's a great example. Okay, it's gone from 130 to just about 210. So you're talking about a 55, 60% move since April. Certainly not the only industry that's done this, but just the fact that it's had that kind of move in all the years I've been doing this, it doesn't mean it can't go to the moon. Sorry, not a aerospace joke this time, but just it can always go higher, but the risk is increasing because all you need is for something to happen that people say, I'm selling it because I made money in it. I'm not talking small investors, big investors. We've made a profit on it. There's going to be other sellers. The hedge funds will try to outguess each other. And before you know it, it's on the way back down. There's nothing that tells me that's going to happen right away. And this 20-day moving average in red is part of that. I'd have to see a little bit more of a breakdown. You see, when it was rolling over just a little bit here, a couple of false alarms, that's why you didn't hear me running out saying, oh my God, the defense stocks are crashing. Okay. That looks more like the defense stocks are crashing. And of course, everything did around then. All the charts looked the same. And, that's kind of what I was, you know, squawking about back in January, February, when the Roar score was down to 10, because I couldn't find literally could not find a stock chart I liked. So the other one, nat gas. I mean, I didn't say this in here, but one of my favorite analogies is Charlie Brown and Lucy. Charlie Brown's going to kick that football. Lucy's going to hold it, and every time she pulls it away, uh, and he just keeps thinking it's going to make it. I'm Charlie Brown with natural gas, so I have tried so many times to try to make a mint on natural gas, but it doesn't chart well. As you can see, double bottom going back to last year. But this ETF is a little bit quirky. But all I'm saying is, okay, she's holding the football again. But this is where position sizing and how you play it. I am much more likely tomorrow to go looking around and say, can I buy a call option way out of the money on UNG? Probably not. It's probably too expensive. There's too much volatility. Although there hasn't been a lot lately. If you see this thing come down, that volatility comes down. By the way, bar chart, very good for that. If you read my articles there, I highlight it all the time. It shows you that IV rank. So maybe a chance to get UNG call options on the cheap because volatility is not that high. The other way is there's probably a lever or a triple lever or whatever. And I take a teeny tiny position, so much so that if I lost half of it, I wouldn't sweat it. But if it starts to go, now it's like an option. I'm doing a lot of that these days. I mean, a lot more than I could possibly relay to you, which is why we're trying to figure out some way to have a trading watch list. We'd love to be able to do it if there's an interest, obviously. But yeah, I mean, every day is kind of a live day with this, and it's not because I've changed my investing style. It's that it's what's available, and like I always say, we have to trade and invest in the markets we have, not the ones we want. So I am going to go over to stocks now. And I'm going to start with this little guy. Oh, look, it's a $4.5 trillion market cap company now. Okay, yeah, I remember when NVIDIA was like, what do they do again? So, and I'm sure a lot of you do too, because it's had quite a run. It's a decent looking chart. That's a decent looking, I mean, really, look, you want to talk about pattern recognition? Does that not look like pattern recognition? Okay. And what I'm telling you is I've seen literally in my career probably over 1 million of these. And out of 1 million of them, probably 3/4 to 80% of them have resulted in additional gains. It's also a daily chart. I didn't use weeklies in any of the ones this week because I'm trying to focus on where there may be opportunities. So NVIDIA is holding up. If NVIDIA is holding up, and Apple and Microsoft actually also looks pretty good. Okay, didn't have it in here, but and when I say pretty good, I mean better than average. But Microsoft, NVIDIA, Apple, if those three are going up, that's 20% of the S&P right there. Amazon doesn't look that good. Neither does Home Depot. Home Depot's already come down a bit. Remember what I said earlier about the retail space. I didn't show the retail ETFs here, but I will in a moment when I go to the scanner. Okay, so that is it on the threes report. I'm going to take a quick sidebar with you here before I get to that guy, the scanner. Wanted to show you this because I want to show you everything first. So a little bit of AI here, okay, but and I'm happy to send anybody. I can chat and then put this outline in the chat. But I basically said to it, go back to about 900 pages in a Google Doc uh, of what I think are all my best writing over the last 25, 30 years from an educational standpoint. And I'm going to spin it out in a few different ways. I hope. Let's go back to here. Okay. This ebook series, two things we're hoping to bring on in the coming weeks: the stock scanner service and the ebook service, or the ebooks, which would be free to you, not free to everybody else. But one of them is, I'm just trying to capture all this so that when people join the club, where people say, really, I don't want to join the club, or I can't afford it, or I'm not ready, or whatever, but I'd really love to get the high level umbrella thoughts, start thinking like this. And I thought, well, how do you deliver that? I could write my third hard copy book. These are the first two. But you're talking 2006 and 2010. So it's been a little while. And since that time, people stopped reading books. So what I'm trying to figure out, and I welcome any feedback, but I was thinking of putting it all together and using what I've been teaching you folks. Okay. Putting it in the terms of the why, the who, the what, the when, and the how. And then dividing it up and calling it. It could be the 3 minute, it could be the 2 minute. I think the average person probably still the average serious investor at least has this 3 minute time span, attention span. Okay. My proof is that you're all still on the call. So to me, helping do-it-yourselfers, but doing it in a way you say, oh, you know what? If you want to, and of course, I mean, everybody tells me I have a great radio voice, I have a great face for radio too, as they say. So uh, maybe if I do these little 3 minute chapters and just keep folding back the onion a little bit more, and I will, happily take some test readers with this. I sent out a couple of the other ebooks, but this is more sort of broad from the top. Might even do it in kind of an A to Z form, but it starts with the why. This is all about you, okay, and then getting into the who, is in who you're going to get ideas from, and it's more a matter of, hey, just be careful with who you listen to out there. Okay, we're Main Street, they're Wall Street. There's a giant gap between them. It's they call the brokerages the sell side for a reason, and how to be an independent thinker, etc. And then the what. What are you going to consider to put together your investing menu? When, you can tell, still in progress. And timing, at least what I call timing. Okay, not market timing the way most people define it. And then how is it going to be? Through ETFs or funds, et cetera, et cetera. So anyway, that's a little sneak preview. Getting closer. That and the Roar Score automation. Kind of just how quickly I can get to it with the people or the robots that are collaborating with me. So, all right, let's go back and look over here, and let's go back to the scanner. Okay. And again, you can see this. I'd love to get some quick feedback on this, actually. The thought was, because we know how it is, despite people's best intentions, most people don't go to this sheet. They go for a little while and then one more thing to do. We get it. we get it. I mean, yeah, I think I probably would be that way too. So what I'm going to do is we'll probably have to do it in a couple of pieces, but we're thinking of what we do is just take this scanner because this is the one part, the the things that you folks have and things that the Substack people who pay have is they get the full threes report, and they get this. And that's where it stops for them, and everything else, including this, what we're doing now, is for you folks. So and you exclusively. So thinking maybe just have this kind of go straight down the page so that you can see this because I'm only updating it on Tuesdays anyway, and make it so this is almost like an addendum to the threes report. So to the extent that anybody has any thoughts on it, I would love to hear them a little bit later. Okay, let's see. And in terms of some things here, just point out a couple. I mean, all you have to do is just look at the colors, okay? There's nothing urgent going on. Maybe we'll wake up tomorrow and the market will change its mind. But, right now, do nothing or do less from a tactical standpoint other than trading this or that. Swing trading, anything beyond swing trading, there's not a whole lot to look at that's really, really moving. That's why I focused this week on what looks like it could move. Okay. So, or as Jerome Powell would say, thinking about, making a move, if you remember that reference. So here are some others, and what I did, I just put them in a straight list. It's a lot simpler, but it's very interesting. Okay, this might be the most impactful takeaway from the time we spent this week. So I mentioned these two. Okay, and I did mention this one here as well as the one that I charted. But when I'm looking thematically here, okay, so for instance, this is the insurance sector. The rest of the financial sector doesn't look that good. The insurance sector looks good. The insurance sector, to my recollection, usually looks good when the market doesn't. Defensive sector. Utilities too. I don't sense at this point this has a lot to do with interest rates because interest rates can't make up their mind still. This is an area, and Jack, try not to write about this one. Actually, it doesn't matter if you can, but these are two smallish ETFs that both try to do the same thing. This one's been a lot more successful lately. This one, not so much, but it's starting to move. What do? They invest in stocks of, let's call it, growing biotech companies. Okay. And if you look at the names, it's like genomics and sort of next great medical discoveries. And I profiled one of these a while back, and it was like, wow, it's like having an ETF that acts like a venture capital fund. The companies are not micro size in most cases, but you got 50 to 100 of them. One of them's 50, one of them's 100, and that's pretty good fodder. Even if it's just to look for stock selection, do more stock research. I think that there may be more legs here. Okay, so that's on the offensive side, but the defensive side, or I should say, the downward-facing dogs, the ones I think look in trouble. Small caps look like they're in a bit of trouble. Retail, as I mentioned, but look what I did here, okay? What do these all have in common? Well, this is the broad retail. This is sports betting, bets, and jets. Jets are the airline companies, the commercial airline companies, keyword commercial. And these are the online payment companies. I looked at it and I said, wow, these four all look not so good. Early signs that maybe the consumer weakness that we keep hearing about, unless you turn on CNBC and they tell you how great the consumer is doing, no matter what, when they're talking about us, not the other 2/3, or the I see a lot of this, and I can show you charts if you want me to pull up specific charts. As a matter of fact, I'm sure we'll get to it with your question, so I can show you a couple of these. But I mean, it's there. It's there, effectively saying, "Hey, watch this space," and the other one is watch this space, the banks. So what would that mean? Well, that would mean higher rates. That would affect the consumer uh, negatively. It could also mean that there's issues with the banks, which I continue to believe we are not done with the regional bank chaos of a couple of years back. So, and small caps also would not do very well, higher debt, et cetera. So if I were going to make a blanket statement out of what they're showing me right now in here, I would say consumer weakness may be getting more attention, higher long-term interest rates being more of a concern, or just the fact that they're already where they are. And that also would reverse any strong trend we've had in small cap stocks in the US, because 60% of this index, the Russell 2000, I'm sorry, 40%, 60% are healthy. 40% can't pay their bills. They have to refinance their debt. Think about that. 40% of a 2000 stock index that for decades has been the small cap index. You know, so if you see RWM, and I don't know if I'm going to do this as we see here today, but if you see, I might look at in Rob's portfolio. Hey, I might look at to do an inverse here. I may look at some of these. I mean, we'll see. And I try to keep this as fresh as possible, so you can see most of these are gone from last week. The China is still in there. That's the one that remained. All right, and let's see. Okay, the model portfolio. I love the fact that we can do this. Yeah, slipped a little in the past week. So far so good with this high yield ETF. Again, it's very much a rental. This again, the income will help, but I won't stay too long here if I think that it's not that rates aren't really going to fall, because this is 1 to 30-year Treasury ladder. Okay, different from the ladder I built for myself, because that's zero coupon. You buy it at this, it matures at this. You have cash flow at maturity coming every year. This year, getting the income along the way. I'm not focused on that for what I'm doing with ladder. The non-US dollar stuff, I mean, yeah, still jury's out. Okay, JP Morgan, what I just said about the banks. Okay, I have this thing now where I mean, look, I am always sometimes quick on the on the sell side. Okay, it's part of risk management. But I have to say, especially a lot of these trading things I've been doing, when I see that something, I own it for a little while, it had its run, but now the run's pooped out already, because it happens all the time in this market. When I see it get down close to break even, just psychologically, I want to try to get out of a profit. I'd like to have as high a winning percentage as possible. So once it gets in there, because I mean, this is not a new position; it's been at least a few weeks. So for a tactical portfolio, they're all up for review at least once a week. So we'll have to see about this one. Again, it's 2% of $100,000 portfolio. But again, this was designed so that if somebody said, "Hey, you know what? I got a spare $1 million. I think I'm going to just track what Rob's doing." Well, then you would own 70 shares instead of 7. So, and then this, of course, has the collar on it. That's still looking pretty good. And the Exxon, I mean, we'll see. Commodities in general have a bit of a lift to them. In fact, that's going to get me right to the questions. But so let's go there, and I will pull up the charts. Commodities. maybe some of the best returns have been made there in a lot of them, but let's see. Okay, okay. Let's see which of these are for me. Ah, okay, got it. All right, let's start with GLD. I like the question, is it overextended? So let me answer it in the way that I own gold right now. Okay, it's not in that sort of teaching portfolio. Okay, if I've been smart enough to buy it here, fine. But I wasn't committed to doing that. What I did instead is I bought call options in one of my little swing trading accounts for IAU, and then now it's on a GLD. And the next thing you know, every 2 or 3 days, you're rolling those call options higher, taking money out, etc. I'd love to be able to teach you guys this, those who want to, but that's a special carve out session. I actually did put a little model of something I did with IBM in the shared sheet, but I haven't really prettied it up yet. So on gold, what I mean, yeah, it was extended here, and now it's way up here. What I try to do with this, I say, okay, let's go out a little bit further. Let's go out 5 years. Well, yeah, I mean, it is extended because of the move it's had, so automatically it's more vulnerable. In fact, um, a lot of the time this can keep going for a while, or it's Nasdaq. This is what the Nasdaq did in early 2000. For 9 weeks it went like this, and then by the end of the year it was like down here. uh Actually worse, it was like down here. It went up 75% and down 75% consecutively in the same year, same 12-month period, same calendar year, actually. Okay, this to me is like, okay, look, this looks just like this, so no, this could be another extension. And I'm going out weekly here. I mean, geez, I go all the way out to monthly and look at it for 20 years. Yeah, this is a bubble that's likely to burst, but I couldn't tell you what day, week, or even what month, because gold is a different animal. Um, it doesn't have earnings, so to speak. Now, one thing, just because you asked the question, how are the miners doing? Miners don't look as good to me on that chart. Uh, but matter of fact, let's just go back to uh, the GLD. Let's just see. Okay, you see this? They were both kind of heading the same way with the PPO, and then this one rolled up. Looks like a Miami dolphin right here, or probably more likely a crocodile or an alligator, and with his mouth out like that. So there's some room, but it's getting late. It's getting late. But late is where some of the best moves. Again, always think back. I should probably write about this. Nasdaq, QQQ, first 9 weeks, 2020, 75%. Maybe it was from November of the prior year, but it was 75, well, almost 100% move in like no time. I'm not taking that off the table. That's why I'm looking at cheap volatility and I'm saying, gee, I can buy a call option on this, call option on that. It's like, lottery tickets, but except that you have better chance with that than you do win the lottery. So because it's hard to stop the momentum when money is just flowing into these things, and that's what's happening. Okay, silver. Is silver any different? Not really. Not really. I'll take a longer look. I mean, when I have to go out to here to try to find a reason it's topping and I can't find it, the only risk in this chart is that when this happens, it's more likely to just right down. So that's the risk. Okay. High reward, high risk. What would that be? By the way, what would the ROAR score be on this? It would be a 40. A 40 on its way to a 10. Okay. Very, very quickly. Okay. So it can happen fast. That's why I say there's a lot of things here just kind of bottle up, waiting to burst, and it might be up and then down as the year goes on, not across. In fact, while I have it in mind, okay, here's the SPY. Okay, I mean, it's not broken. It's flat. It just keeps rolling higher. So what I look for is, okay, is there any supporting evidence? And here's the supporting evidence. This is not rolling higher. This has been flattening out for a couple of months. Same stocks, equally weighted. So I think that is probably the indicator to me that, hey, don't, maybe the very, very, very top, it could be okay. In fact, I'm curious, what does top T look like? I'll check that one. This is the 20 largest stocks in the S&P 500. Similar type of picture. So it's crowded at the top. This is not a stock bull market at this point. It's a very selective, push them higher because money's going to index funds bull market. That's what it is. Okay, let's see. GLTR, is that part of the same? Yep.
Yeah. So Rob, just to tell you, glitter is like gold, silver, platinum, and palladium, kind of all bundled into an ETF. So the question kind of became like, if those are too extended, is there any safety in diversity among the precious metals? And by looking at this chart, I think I know what you're going to say.
The best diversity would be to go in here where there's liquidity and go somewhere in here, and you, hopefully using some of the stuff that I've taught you guys, go in and find yourself a collar, or more likely find yourself a married put. Okay, that IV rank is fairly low, and you probably can get some cheap insurance on a position you have. Matter of fact, let's just do one quickly. Let's go out. Let's go out almost 3 months. Okay,
This is
and
super helpful because I have a collar expiring soon.
hey, there you go. All right. Let's see. Okay. By the way, people have been asking, and I read so many articles about collars now for bar chart. I just instinctively now go and I say, okay, let me put it in at, just below or at the money, because there's going to be a cost to it. Okay, I want my cost to be my downside. Matter of fact, let me do this. I can get them both on there, and let's see. I want to look at the 350 and I want to look at the 355. The 350 there. So it costs you $855 or $855. And again, you can use IAU, lower dollar price. That's the one I used before. But so $855 to hedge $35,000 in GLD for about 12 weeks. So your downside is about 4%. It only needs to go up a couple percent, which asking gold to go up a couple percent, if it's going to go up, it's going to go whoosh. So that would be my view. Here, you could do it at 355. You got a little higher break even. Your cost is a little bit lower. So I mean, somewhere in here, then I would zero in. And since you asked, and since you are my friend, I'm going to look at the collars, expecting that this bid column, which is the covered call part, is just not going to pay me enough. So here, let's use the 350. So now I'm just going to isolate. Oops, like two. I'm going to isolate. These are all the 350s with their respective covered calls. And then what I do is I go over here and I say, okay, 21% upside, 4% downside, sign me the blank up. Except, let's see. Yeah, it's not bad. I mean, the cost is only 2.3%, but here's the problem. Do you really want to give up the upside if it somehow blasts above 440 in the next 3 months because you had to have 44 cents? So what I would do instead is I will look, really good example, Jack, thank you. Let's see. So now what we're going to do is say, all right, well, I mean, look, if we go back to the chart, I could tell we're in uncharted territory, okay? So let's say, all right, if I'm willing to give it downside, it's 355 price. If I'm willing to cap my loss at 350 plus whatever the cost is, let me see. Well, I could go all the way to here and have no cost, but I also have no upside. So it's got to be some. This is sort of the pendulum here. So as an example, say, all right, it's at 355. What's 10% up from there? 390. Maybe a little bit more if you're a gold bull. Okay, this downside is not changing that much. So here, somewhere in here, just as an example. Okay, 350, 410. I feel a little bit better because I'm getting some offset to my put strike with my calls. And this is the pendulum, you can do it this way. Remember, you're only talking about 3 months. If 9% upside and 3.25 downside, at a modest cost for 350, 390. So, and this is why I struggle to say to people, oh, this is the one you should do. Completely personal preference. And unless I'm running a hedge fund or something that does this, like I used to, then I think I'm better off teaching it. Okay.
Sweet, thank you.
Good. Let's see. Okay. Yep, Fez better. Yeah, overview. That's right. Jack studies the international markets, and he says, yeah, okay. Let me see. Yep, outside of the top gems, yeah, ASML, LVMH, the European big boys there. It's a mausoleum economy. Yes, it is. Okay, let's see. Jim, thank you. One looking for European defense ETFs. There's EUAD and WDEF. WDEF. That sounds like a radio station. Says the old radio guy. Okay, good. Thank you for pointing those out. Yeah, it's there's an ETF for just about everything. Okay, let's see. Yep, stayed away from my RG experience during the pandemic. Yes. Okay. Let's see. Okay. Teresa, with keeping her streak alive of every week asking an excellent question. Okay, for the 3-minute reports, consider adding your best estimate for the time needed to manage a portfolio in hours a week. Also, strategy for timing of systematic portfolio review and how to do. Oh, that is so good. Hold on. I want to make sure. Now, I might have already included that at some point, but probably not that specifically. So let me just do myself a favor and then I'll get to the rest of the questions here and then we'll finish up. All right. There we go. Okay. I just have to put this somewhere, there, I'll pop it right at the top. Okay. All right. I need full transparency here. Okay, let's see more. Okay. GLD, a lot of talk about the yep. Okay. Yeah, right, Jack. Radio stations start with a double. You're right. Yeah, here they do. KLA or whatever. Okay, so let me see here. Okay, so look, I mean, Teresa's question, I can give you part of an answer, and it is right here. That's what this is for. It's not the only thing it's for, but when I have a bad habit sometimes of saying, "Oh, okay, I've done all the work, I put it out there, I have the whole thing, and I expect that everybody's going to understand it right away." This is the only so much time in a day or a week issue, but uh, but I certainly, uh, you know, as a writer, this will end up being probably an entire chapter of the book in 3-minute segments. So let me give you the quick answer here. And I encourage you to look at this because I always like to know, like, hey, did this explain it? Do you know what to do now? I'd love it if a couple of you, can look. This is right here, ETF model portfolios. So I would say this, okay. Obviously, this is not going to take you a long time if you decide that, like I do with this typically, that unless the market's chaotic one way or the other, like you're waiting for a breakout and all of a sudden you get it. It's taken weeks, like with the Roar score. Think of the Roar score itself. That's what this is, right? So it's been a 20 for so long. Okay. When I finally see that it's moving one way or the other, I'm not going to look at my watch and say, oh, I got to wait till next Tuesday. But you can have a process that says, Tuesday is my review day. Tuesday and any other day that I really need to pay attention, but with the idea that it's almost always Tuesdays. So 52 times a year and maybe occasionally a different one. And all you're doing is doing this. Now, how long does that take? Uh, it depends on what you want to build into your decision making. I mean, for me, it's a chart, but it's also all week. I'm kind of, the Roar score, the non-quantitative part, is constantly moving like this. Okay, with every little bit of information I take in. Yeah, professional money manager for decades. Okay, I don't think I'll be able to unwind that. When I'm 95, God willing. So, uh, but what you can do is say, okay, I'm going to look at something every week. I mean, look, the Threes report is kind of designed for that, as a shortcut anyway. And then with these, they say, okay, how much more do I want to build from here? Well, obviously, tier 2 portfolio where you have not just this, you're not just allocating this and this, you're allocating to one or more of these and one or more of these, and then sub allocations. Okay. And I'm starting to do this here, but honestly, I mean, look, I would, if I thought it was really going to move the needle for people, uh, you know, I'd like to try to turn this whole thing into almost like a build your own portfolio tool where you not an advisory thing. Sure, investment advisors could use it, but where you answer a handful of questions and it gets you in the zone, like, hey, you should probably look at 3 or 2 because that's the amount of time you're going to spend. So yeah, we're we're hopefully getting there. If you want to do something like this can also be done in minutes a week, minutes a month. It all depends really on how much time, I should say, how much risk you want to take. And in this regard, I will say there are 2 types of risk. There is just plain old, risk management, big moves up and down. But what about the micro moves? Okay. I talked about the JP Morgan. Okay. So let's take a look at that one. So tactical portfolio that I run and show you guys, JP Morgan right here, showing signs of maybe rolling over, not showing signs in a good way, showing signs in a bad way. Let me step back, look at it in a weekly, it's still a lot of nothing, okay? So I'm kind of on guard here. I'm not doing anything yet. I know the other banks look like they're breaking down a little bit. I mean, this is the community bank ETF. I think you can see the difference, right? This one's already, false alarm. See if it's another false alarm, but maybe not. Okay. This one, back last time there's a crisis, this one went from 66 to 45. That's 35% decline in a short amount of time. That could take place across the entire equity market at some point. There's no damn way I'm ever going to let that happen with my money. However, I can, if I'm playing offense and defense at the same time, even if I own something, that's a little bit, whatever, equity market gets very dicey. Okay. If I want to, own something that's, let's say, volatility related, which should spike up if the market really gets hit hard. If I want to short small caps because they're usually more vulnerable. If I want to short S&P, or just put a lot of money into bill, kind of like we're doing here. So again, there's no one right answer, but this should help you, because that's what I designed it for, is to allow you to decide how many boxes, how often do you look, etc. And all I would say is, before you decide, I'm only going to look this once a week, once a month, twice a week, whatever. Before you do that, stress test it. There's places, things that you can use, on the web. I think Portfolio Viz and a few others. But more than that, just look at everything that you'd ever consider owning and say, geez, if I own it now, like, how bad has this thing gotten? And it's nice if you can do something like this. So let's see. All right, I'm going to look at Genom, and I'm showing this is Y charts, which is not much more kind of an institutional thing, but and I'm kind of frankly looking. By the way, Jack, you of all people would probably know. I'd rather not stick with Y charts forever, because it's really an advisor tool. But let's take a look at this. So I'm kind of looking for how I can substitute for pieces of this. Okay, so this thing in its first couple of years, it had very brief drops from its all-time high. But as we sit here today, it's still down 2/3 from whatever high price it hit. I don't know, like back here somewhere. Okay. Even the broad market can fall by that much. How much is the S&P? Well, I mean, people are amazed when they see this, but here in the SPY era, okay, I'd be curious. Is anybody surprised by this? Is this new? That's a 20. That's a 29. It's a little bit bigger. .com 47%. A little bit worse intra-week, but I think this is like weekly runs. Oops. What was this? 55, something like that. There, 56, 57. Okay. Another one here. But you know what the difference is? That's risk management right there. All people know is it falls from its high and it gets right back up. Look at how quickly, quick, 3 times. Okay, all in the last 5 years. That's not quick. You're at an all-time high in March of 2000. Okay, you didn't stop falling till here. You didn't even get back to that same all-time high until 2007. Oh, and then it happened again. All this white space here, that white space is lost time in your life to live your lifestyle while being concerned, hey, is my stock portfolio ever going to recover? Is it going to recover in time for me to be able to spend what I want to spend, etc.? Same goes for any security, any portfolio. And that's why the time frame is so important because you want to try to figure out what really matters. Okay, so that's all I have, unless there's more here. Sign to sell from these highs. One more, get to that. So I'll just use the old S&P. There's two answers. The main answer would be, I will first start looking for this to roll over. Okay, you see how it keeps threatening. It's what keeps the Ruhr score lower. You see what happens when it actually does roll over? That's not good. Okay, and when it does it on, and if it does it on a daily time frame, maybe it will recover a little bit faster. Okay, but here this is 20-week moving average, but same principle. It rolls over a little and a little bit of time, but it didn't get back on its feet until about here, and the PPO kind of confirms it. So I use these together a lot, but over different time frames. And right now, what it's telling me on the weekly time frame for SPY is it's high, but it hasn't rolled over yet. So, but there's the one caveat. See, flat. Okay, I want to see it do something that looks a little more like this. You see that black line coming down through here? This is going down. Then eventually the green one, the 50-day, rolls over with it. Okay, but here's the one bugaboo with this, gang, and I think we'll close on this. The one thing that the charts are not going to help you with as much precision is if it happens in a flash, which means a day to a month, maybe a couple months. We haven't had one in a long time, and I'm not sitting here predicting one, but I'm just saying that with each passing week, I feel like the odds of that are moving higher. And so I just find more ways to manage risk. At the same time, my portfolio at this point is kind of a barbell. Now, I have some small positions set up to go big. I have some small positions to be crash insurance, and I have kind of a core in between. But a lot of the core, frankly, at this point is bond ladder and an S&P or a SPY collar. The collar takes a lot of that worry away. And you sacrifice some upside, but frankly, you may not sacrifice much at all if you just use put option on it and do the married put strategy. So, all right. Got a lot in there. If there's any other questions, just open up your mics. Otherwise, that is a wrap for today. And thank you for hanging around. All right. Take care, guys. See you next week.